probably heard most financial planners say it's a good time to invest in shares now. But what the hell are shares? How do you make money? And where do you invest in them? Now, if you're like me, you've probably Googled your way through by now. You've probably heard about companies that's listed on the JSE, such as Naspers, MTN, and so on. Now, when a company wants to expand, they need money. So they can either borrow money at a bank and sit with a huge amount of debt, or they can sell shares in the company. When you buy shares in a company, you become part of the company as a shareholder. This means that you'll actually have a say on how the company is run by voting on the annual shareholder meeting. But how do you make money? Well, the first way is by receiving a dividend. So when a company made a profit, they can either decide to retain the profits in the company or share it with the shareholders by distributing what is called a dividend. Naturally, the more shares you own in a company, the greater your share in the profits would be. You'll receive a dividend for every share that you own. If you own 1,000 shares and a company decides to distribute a dividend of R1 per share, you'll receive 1,000 Rand. The second method is when the share price rises. You've probably heard about the saying, buy low, sell high. Share prices can sometimes be volatile, and they're influenced by numerous factors, such as economic climate, news, and obviously their financials that showed how well the company did or how poorly they performed. If a company performed better than expected, the share price will increase and vice versa. It's all about supply and demand, or the willingness to buy a share or sell it. You see, if a company does well, everyone wants a slice of the pie, driving the price up. But if everyone wants to get rid of their shares, like if we take the Steinhoff or the Sasol saga lately, that will see the share price drop. Because if there's more people willing to sell their shares than people willing to buy, that'll drive the price down. But here's something many people miss when it comes to shares. If you bought 1,000 shares at 10 Rand per share, your share portfolio would now be worth 10,000 Rand. Now let's take the current situation as an example. As COVID-19 came into play, many companies were not able to perform as usual and are expected to take a knock when it comes to their profits. This would naturally drive the price down. So let's say people are only offering you 5 Rand per share instead of 10 Rand. This will see your share portfolio cut in half. You wouldn't sell your house if the housing market crashes, right? Because you still own your house. The same is true when it comes to shares. You still own 1,000 shares, and the company that you invested in will still own their property and their stock and contracts. This means that the company still has an intrinsic value. With shares, it's kind of the same. Although your portfolio might only be worth 5,000 Rand, you'll still own 1,000 shares. And if history taught us anything, it's that markets will pick up again. Let's take the 2008 crisis as an example. The markets took about 18 months to get back to its previous highs. That's why you should keep your shares and not sell out when the market crashes. Because if you sell at 5 Rand, you'll only realize your loss. It sounds crazy, but it's actually a good time to invest more. If you invest more now, you'll actually bring down your average share price. As Warren Buffett said, buy when there's blood on the streets. It's not going to be doomsday forever. One day things will return to normal. Just be careful of the emotional attachment when it comes to shares. They are volatile depending on the companies you invest in. There are obviously shares that's less volatile, which is maybe a good thing to look at. You should also determine what type of investor you are. Are you a speculator or a long-term investor? Speculators are more active. They buy and sell shares, trying to speculate what the share price will do next. Long-term investors have a much more passive approach and would rather invest in a company that has long-term potential. They're not worried about the short-term volatility, as it's kind of something that is synonymous when it comes to shares. Now that we know that, you need to know what to buy. Well, as Warren Buffett said, and I think I'm quoting him quite a lot, but as he was one of the most successful investors, I think it's all right. Warren Buffett said, buy something that you think will be around in the next 20 years. Think about food. I mean, everyone needs to eat. Think about tech, pharmacy, finance, and so on. Don't just buy anything. Do your research properly. If you invest in a friend's company, you'll surely want to know what's going on. And the same goes with your share portfolio. I do think you need a fair amount of knowledge when you want to invest in shares, but it's not impossible to learn the basics relatively fast. Diversification is key to spreading the risk. Don't put all your eggs in one basket. I would suggest pick 5 companies and start there. Now you might be thinking, when is the right time to invest? What if the markets fall and if I just invested right now? There's an old saying that says, it's not about timing the market, but rather time in the market. You might get it right this time, but not necessarily next time. I mean, not even some of the best fund managers in the world gets it right all the time. Unless you're speculating, which looks pretty awesome, but it's flippin' damn difficult. Okay, so now that we finally know that, where can you actually buy shares? Well, there's numerous platforms out there like Easy Equities or Standard Bank's online share trading. Find one that works for you and stick with it. You can usually start with a demo account, and I really recommend that you do that. Pay careful attention to the emotional attachment when it comes to your demo account's money compared to your real money. Create a watch list where you can keep track on the potential companies you're interested in. Do your research properly. Be careful of leveraging. There are alternatives like ETFs, which is called exchange traded funds, that tracks a group of shares or a basket of shares like the SA Top 40. Now, those ETFs can easily be bought and sold the same way as shares and immediately allows you to diversify. And they're pretty cost effective as well. Or if you're like me, there's a much easier and I think a little bit safer way, and that's by investing in unit trust. When you do this, you give your money to a fund manager that makes those decisions for you. They sit with a team of analysts and economists and are probably much more in the loop compared to most people. Anyways, I hope that this video helped you decide what to do next. And until next time, bye-bye.
Thank you!